First of all, this thumbnail is not clickbait. I promise you, you will save thousands of dollars by watching this video as I'm going to go through 5 common mortgage mistakes that I see as a mortgage broker after helping hundreds of clients. So whether your mortgage is coming up for renewal, you're moving in the near future, or you plan on refinancing your mortgage, this video is for you. What is going on, friend? Tom back here with another video helping you save money in mortgages and real estate. So these 5 tips that I'll be sharing here today are from years of helping clients as a mortgage broker. And as you can imagine, I've seen some shit. So starting off with point number one, I see a lot of people trying to pay off their mortgage aggressively, which is great. But if you're leaving high interest debt on the side, that's not such a great thing. So, what I see a lot of people struggle with from a mental perspective is if they have debt sitting outside of their mortgage and they're just trying to pay down their mortgage as fast as possible, and that's their main goal, then they typically leave that high interest debt sitting on the sidelines, which obviously isn't a good thing because you'd much rather have that tied up into a lower interest rate. And whenever I talk to some clients that are in this scenario, they're very hesitant to increase their mortgage amount because, of course, their main objective is to pay down the mortgage. But not only are you going to be saving on interest, whatever the savings is, that's going to increase your monthly cash flow. So, what I coach clients on doing is whatever that savings amount is, just allocate that towards the mortgage and it's going to help you pay down that mortgage faster. So, to give you a good example, we had a client that came to us for a renewal. And what we did was we looked at the whole picture and we saw that she had $40,000 sitting on her unsecured line of credit. So that line of credit had a 12.5% interest rate. So what we did was we bundled that in with her mortgage, which had a 5.2% interest rate. So right off the bat, she's saving $500 a month. So now with that $500 a month, what we did is we coached her and said, hey, put your payments on autopilot. You can increase your mortgage payment and put that extra $500 straight towards principal and pay down your mortgage aggressively. So point number two, locking in to a 5-year fixed. Now, I know you're saying, well, what's wrong with the 5-year fix? It's one of the most common terms that we see out there in the mortgage world. Yes, that's true. But right now, we are at the peak of interest rates. We're probably going to be seeing interest rates decrease within the next year or two. So it doesn't make sense to lock into a 5-year fix at the peak of rates. Now, yes, the 5-year fix is the lowest rate typically. So sometimes it does make sense for clients if they just want to optimize on cash flow. But typically speaking, if you want to save the most amount of money long term, you're better off going with a short term fixed rate. Now, of course, it really depends on where rates are at the time. If you're close to the bottom of rates and we feel that you're going to have a good runway with the 5-year term, then of course it makes sense to lock into that 5-year fixed. The one thing I will say though to add to that is a lot of people don't understand how mortgage penalties work. So a mortgage penalty is incurred if you break your mortgage. So anytime you either move, refinance, you might incur a penalty. Yes, there's ways to get around that. But generally speaking, if you are about to break your mortgage, you're going to be paying that penalty. And with the fixed rate, you're going to have the highest penalty. Now, I have another video going over that. I'm not going to explain all of the details on how penalties are calculated. Just know a 5-year fixed rate with a big bank is going to be your biggest penalty, and you can assume a 3 to 5% penalty based off of the remaining mortgage amount. Now, assuming you have a mortgage amount remaining of 500,000 at the time of breaking, then you can assume you have a minimum penalty of 15,000 in that scenario. Now, point number three, not using your prepayment privileges before moving. So first of all, let's back up and explain what prepayment privileges are. So every mortgage you get, you do have the ability to pay down your mortgage through what's called a prepayment privilege. So every lender is different. You can have between 10 to 20% of prepayment privileges, which allow you to put a certain amount of money towards the principal on an annual basis. So if we use an example of a $500,000 mortgage and you have a 20% prepayment privilege, then you'd be able to put $100,000 towards that mortgage on an annual basis. So how does this tie into the scenario of you moving? Well, if you're moving and you are going to a new lender and not porting, so taking your current mortgage over to the new property, for whatever reason, maybe you didn't qualify with your current lender, or maybe you just wanted to optimize on the interest rate. If you're going to a new lender and you're about to break your mortgage, then you are going to incur that penalty that we just discussed. So if that's the case and you're about to incur a penalty, the best thing you can do is use your prepayment privileges. So going back to that example of a $500,000 mortgage, if you allocated $100,000 and knocked that mortgage down to 400K, your penalty is going to be much, much less. Now, speaking of mortgage porting, this is point number four, not going to a lender that allows you to port your mortgage in the future. Every lender is different when it comes to porting. So it's very, very important when you sign on to your new mortgage, you ask either your mortgage broker or the bank rep, what are the mortgage porting features and how do they work? The last thing you want is to pay a penalty in the future if you can't port your mortgage. So, a classic example and something that we see all the time is if someone is with a credit union and they want to move out of province, then they're not going to be able to port their mortgage. So, while although credit unions have some pretty aggressive rates at times, it's going to cost you much, much more in the form of paying a penalty versus whatever rate you saved on during the term. And with housing being more unaffordable in Ontario, for example, we're seeing a lot of people move out west to, say, Alberta. It's becoming more and more common. And we're seeing more of that scenario of someone locking into a credit union mortgage and not being able to port it and bring it over to their new property. And number five, beware the cosigner. Yes, that sounds counterintuitive. You probably hear people say, well, the best thing for a first time home buyer is to get a cosigner to help with the mortgage. But with that being said, what we try to do is we try to look at big picture for clients. So you want to make sure that you can afford the payment because while although yes, it is nice to have a cosigner and it helps you afford the home, gets you approved for a mortgage, that payment is likely going to be higher than what you would have qualified on your own. So, what we do is when we talk to clients, we make sure they're comfortable with the payment because the last thing we want for them is to be house poor, move into the home, and realize, shit, my payment is way too high. I can't afford this. I'm going to need to either sell this or really just get someone to bail me out, like my parents, and help me with the payment. So, I'm curious, have you ever made any of these mistakes in the past and wish someone told you this? Let me know, comment down below, and make sure you hit that shiny subscribe button. Help us out, and we're going to help you out by releasing new videos in the future, helping you save money with mortgages and real estate.